Well, we're less than 2 hours away from hearing what the Fed's next move is going to be. The Fed is expected to stay. QE2 is going to end, and interest rates will remain steady. So how are markets going to react? Well, let's ask Michael Pond. He's the head of interest rate strategy at Barclays Capital. Hey, Michael, great to have you.
Thanks for having me on.
So, Michael, try to just give us a quick synopsis. What are we going to expect to hear from the Fed in a couple hours?
Well, what we'll be watching for is any change in their outlook for the second half of 2011. So the Fed right now is essentially stuck on the sidelines because the economy isn't growing fast enough where they're actually start to tighten policy, but it's not growing slow enough that we're likely to see QE3. So right now they're on the sidelines, and what we're looking at is, or looking for, is whether they think that the soft patch might continue into Q3 and Q4.
Well, you know, the concern is so many people, including the IMF, by the way, have lowered GDP forecasts to around 2%. That's a problem for the economy, isn't it?
Well, they've lowered forecasts, but those forecasts are for the first half. It's the second half that everyone is still fairly optimistic about, including our forecast, including the Fed's. First half growth is coming in lower than expected because of a series of one-offs. So because of the supply chain impact of Japanese earthquakes, because of high gasoline prices, droughts and floods, and strong winter weather, that all drove consumer spending to decline, real consumer spending to decline. What we're focused on is the second half, as is the Fed. The second half looks brighter, but we'll see how it comes out.
Michael, I wonder how you think the European debt crisis, not just in Greece, but potentially spilling over into other parts of Europe, factors into how the Fed proceeds with its policy.
Well, it creates another uncertainty out there. So the Fed is not just looking at a baseline economic forecast, but things that could go bump and cause that economic forecast to go down or up. So Greece is certainly important in that context. Another situation that we're watching closely is the fiscal debate, and whether the debt ceiling will be raised on or about August 2nd, and whether there'll be a considerable fiscal drag, which could cause the economy to slow later on this year.
But, Michael, does anyone honestly think that the debt ceiling is not going to be raised? Because if it's not, then all of a sudden we're out of money.
Well, you can't completely rule it off, take that off the table, given that some in the Tea Party are saying that wouldn't be a bad option. We certainly think would be an awful option. We're not concerned about a missed coupon payment, but we are concerned about essentially a government shutdown that would essentially cause a double dip in the economy.
Michael, you're head of interest rate strategy over there at Barclays. With the end of quantitative easing 2, or at least new purchases of treasuries, what impact would that have, not just on treasuries, but on other credit products?
Sure. Well, many have been saying that with the end of QE2, with the biggest buyer of treasuries so far this year out of the market, that means that treasury yields go up. We've had the opposite view, essentially thinking that it won't be a big deal because it's already priced in the market. Everyone knows that program is coming to an end, so it shouldn't have a big impact. And in fact, going into QE2, that was a risk on trade. Investors moved out of treasuries into equities, into commodities, into other more risky assets. So with the end of QE2, there's certainly a possibility that investors who had gone into risky assets start to come back into treasuries, and that's where potential demand could come from. So we're not worried about the demand side. We're much more worried about the impact from the economy on rates.